It's really striking how fast things change, especially in crypto. One moment it feels like the Wild West, the next, well, major regulations are coming down the pipeline.
Absolutely. And in the UK, we're seeing a pretty significant development, aren't we? A new requirement that's going to bring a whole new layer of scrutiny.
Right. It seems like as more people get into digital assets, governments inevitably start taking a much closer look.
That's the pattern.
Yeah.
So today, let's do a deep dive into this latest UK move, this mandate for crypto firms to report, well, pretty much every transaction their customers make.
Yeah.
We'll break down what it means, look at the why behind it, and maybe see how it fits with what others, like the EU, are doing.
Okay, let's get into the details then, starting January 1st, 2026. So, firms have a bit of time, but not loads. UK crypto firms have to keep incredibly detailed records.
And detailed is the word. We're talking full name, home address, tax ID number for every single transaction.
Every single one. That feels substantial.
It is. And it's not just, the total value. It's which crypto was used, the exact amount moved each time.
Wow.
And this doesn't just apply to individual users, right? It also covers companies, trusts, charities, basically anyone using these platforms.
And if firms don't comply, or if the reporting's inaccurate,
there are penalties, up to 300 British pounds per user.
Per user. Ouch. You can see how that could stack up incredibly quickly for a platform.
Definitely a serious incentive to get it right. Now, the UK's tax authority, HMRC, they've said more detailed guidance is coming, but they're already telling firms, start collecting this data now, which tells you something about the scale of the tax.
Yeah, it signals this isn't just a minor tweak.
Not at all. And it's not happening in a vacuum. This is the UK bringing in the OECD's Cryptoasset Reporting Framework, the big aim. More transparency for tax purposes. Simple as that, really.
Okay, so that's the what. Let's talk about the why. What's the bigger picture driving this push for such, well, comprehensive data collection?
Well, looking broadly, the government's been signaling for a while it wants a more, let's say, robust regulatory framework for crypto.
Trying to find that balance, I suppose,
Yeah.
between letting the industry grow and protecting people.
Exactly. Supporting growth while beefing up consumer protection. We saw steps towards this back in April, remember? There was that draft bill.
Oh, yeah, the one targeting exchanges, custodians, broker-dealers.
That's the one. A key goal there was explicitly about tackling scams and fraud, which have been, a real issue.
And wasn't there that quote from the Chancellor, Rachel Reeves? Something about being open for business.
Yes, exactly. She said, today's announcement sends a clear signal. Britain is open for business, but closed to fraud, abuse, and instability. Pretty direct.
It certainly lays down a marker, and it comes at a time when crypto ownership is really growing, right?
Massively. The Financial Conduct Authority figures showed 12% of UK adults owned crypto in 2024.
12%. What was it just a few years ago?
Back in 2021, it was only 4%.
Wow, that's triple. Okay, so you can see why regulators might feel the need to step in more forcefully.
Precisely. More people involved means a greater need for clear rules, consumer safeguards, and just maintaining financial stability overall.
Now, it's always interesting to see how different places approach these things. Our sources mentioned a contrast between the UK and the EU's approach to their MiCA framework. Can you unpack that a bit?
Sure. It's a key difference in strategy, really. The UK seems to be integrating these new crypto rules into its existing financial regulatory structures.
Sort of slotting it into what's already there.
Kind of, yeah. Whereas the EU went down a different path. They created an entirely new bespoke framework just for crypto assets that's MiCA, Markets in Crypto Assets.
Okay, a whole new rule book.
Right. And according to the MiCA Crypto Alliance, a group focused on this stuff, one big practical difference is around stablecoins.
Ah, stablecoins. The ones pegged to traditional currencies.
Exactly. The report suggests the UK might allow foreign stablecoin issuers to operate in the UK without needing a specific UK registration.
Interesting. So, a potentially lighter touch for overseas stablecoin providers compared to the EU.
That seems to be the implication, yes. Which could, make the UK look more attractive initially for those international players.
Could lead to more stablecoin activity, perhaps.
Potentially, yes. More liquidity, maybe more innovation in that specific space in the UK, at least early on. But of course, it also raises questions about oversight for those foreign entities operating here.
A definite trade-off to watch.
Oh.
Any other key differences that stand out?
Yeah, another one linked to stablecoins, actually. Volume caps.
Meaning?
Well, the EU's MiCA framework includes provisions that could allow regulators to impose controls, maybe even caps, on the size or volume of certain stablecoins if they become systemically important. to manage risk.
Right. If one gets too big, it could pose a risk to the wider financial system.
Exactly. The MiCA Crypto Alliance notes that the UK approach, as it stands, doesn't seem to include similar caps or volume controls.
So again, potentially more open field for stablecoins in the UK compared to the potential restrictions in the EU.
That appears to be the case, based on this analysis.
So, thinking about you listening, why does all this regulatory talk matter? Whether you're deep into crypto trading or just, crypto curious, these shifts have real-world effects.
They really do. For users in the UK, obviously, there's the privacy angle. Knowing every transaction detail, name, address, amount, crypto is being reported, well, that's a significant change.
Yeah, it raises questions about data security, too.
Absolutely. And for the crypto firms, this is a huge operational lift. Building the systems, the processes, ensuring accuracy, it's a major compliance task.
And stepping back, this isn't just a UK thing, is it? It feels like part of a much bigger global trend.
Oh, definitely. We're seeing regulators all over the world grappling with crypto, the US, Asia, the EU with MiCA, now these UK rules. It's a clear global move towards more oversight, more defined rules.
Trying to bring crypto into the established financial fold, perhaps.
I think that's a big part of it. Making it fit, making it safer from a regulatory perspective, integrating it more responsibly.
Okay, so let's quickly recap. The UK is bringing in these quite detailed reporting rules for crypto firms from 2026.
Yep. Focused on tax transparency, fighting fraud.
It's part of a wider push for regulation, integrating into existing frameworks.
Which differs from the EU's approach, particularly around stablecoins, where the UK might be somewhat more permissive on foreign issuers and volume caps, at least initially.
Right, which brings us to the final thought for you to ponder. As crypto keeps evolving at this breakneck speed, where's the sweet spot?
Exactly. How do we balance the very real need for regulation protecting consumers, ensuring stability, with the desire to foster innovation and, importantly, respect individual privacy?
And thinking longer term, what might be the impact of these diverging paths? The UK's integration approach versus the EU's bespoke MiCA framework. How could that shape crypto adoption, innovation, and, well, the whole financial landscape in Europe and beyond?
Yeah, what do these different regulatory bets mean for the future? Definitely something to keep an eye on.